Have you ever wondered why everyone keeps talking about Bitcoin, Ethereum, and those mysterious digital coins that seem to make some people rich overnight, while others lose their life savings? Well, buckle up, because today we're diving deep into the wild world of cryptocurrency. And by the end of this video, you'll understand exactly what crypto is, how it works, and why it's either the future of money or the biggest bubble in human history. Let me start with a story that might shock you. In 2010, a programmer named Laszlo Hanyecz paid 10,000 Bitcoin for 2 Papa John's pizzas. Today, those same Bitcoin would be worth over $400 million. That's right, the most expensive pizza in history. But here's the thing, back then, nobody really understood what they were dealing with. Just like most people today, still don't understand what cryptocurrency actually is. So let's fix that right now. I'm going to take you on a journey from complete crypto beginner to someone who genuinely understands this technology, its potential, and its dangers. We'll explore how digital money is created out of thin air, why some projects are worth billions while others are complete scams, and how ordinary people have both made fortunes and lost everything they worked for their entire lives. To understand cryptocurrency, we need to first understand money itself. Throughout history, humans have used different systems to trade value. In the beginning, we had simple bartering. You had a cow, I had wheat, we made a trade. But this system had a massive problem. What if you wanted my wheat, but I didn't want your cow? The trade couldn't happen. This led to the invention of commodity money, like gold and silver coins. These worked because everyone agreed these materials had value. You could trade your cow for gold coins, then use those coins to buy whatever you wanted, even if the seller had no use for cows. The British pound literally got its name because 1 pound used to equal 1 pound of silver. Then came government-backed paper money. Instead of carrying heavy gold around, governments issued paper certificates that promised to pay the bearer a certain amount of gold or silver. This was more convenient, but it required trust in the government and banking system. As technology advanced, we moved to digital banking. Today, most money exists only as numbers in computer databases. When you buy something online, no physical money changes hands. Your bank just subtracts numbers from your account and adds them to the merchant's account. Now here's where cryptocurrency comes in. It's essentially the next evolution of this digital money concept, but with one crucial difference. Instead of relying on banks and governments to manage the system, cryptocurrency uses computer networks and mathematical algorithms to handle everything automatically. Think of cryptocurrency as a completely digital form of money that exists only in computer networks. There are no physical coins, no paper bills, nothing you can hold in your hand. But just like traditional digital banking, it's all about the keeping track of who owns what and who pays whom. The revolutionary part is how this tracking happens. Instead of one bank keeping records, cryptocurrency uses something called a distributed ledger. Imagine a massive spreadsheet that records every single transaction, but instead of one copy sitting in a bank's computer, there are thousands of identical copies spread across computers all over the world. This is where Bitcoin gets its security and trustworthiness. Every time someone wants to send Bitcoin to someone else, the transaction gets broadcast to this entire network of computers. These computers, run by people called miners, all check the transaction to make sure it's valid. They verify that the sender actually has the Bitcoin they are trying to send, and that they haven't already spent it somewhere else. Once the majority of computers agree the transaction is legitimate, it gets permanently recorded in the ledger. This process happens automatically, without any banks, government agencies, or central authorities involved. It's peer-to-peer digital money. But here's what makes it really clever. The ledger isn't just a simple list of transactions. It's organized using something called blockchain technology. Each group of transactions gets bundled together into a block, and each block is cryptographically linked to the previous block, forming a chain. This creates an unbreakable record of every transaction that's ever happened. If someone tries to cheat the system by changing old transaction records, the blockchain would immediately detect the tampering because the mathematical links between blocks would break. To successfully hack the system, you'd need to simultaneously change the records on thousands of computers around the world, which is practically impossible. Now, you might be wondering how new cryptocurrency actually gets created. This happens through a process called mining, though it's nothing like digging for gold. Mining is essentially a mathematical competition where computers race to solve complex puzzles. The first computer to solve the puzzle gets rewarded with newly created cryptocurrency. This serves two purposes. First, it provides an incentive for people to maintain the network by running those verification computers we talked about. Second, it controls how new currency enters circulation, similar to how central banks control the money supply, but with predetermined mathematical rules instead of human decisions. Different cryptocurrencies use different mining systems. Bitcoin uses something called proof of work, where computers compete to solve mathematical puzzles. Ethereum originally used this system, but recently switched to proof of stake, where people lock up existing cryptocurrency to validate transactions and earn rewards. Other systems like delegated proof of stake let coin holders vote for validators who process transactions on their behalf. The genius of cryptocurrency is that it solves what computer scientists call the double spending problem. In the digital world, copying information is trivially easy. You can copy a photo, a document, or a song millions of times with no degradation. But money can't work that way. You can't spend the same dollar twice. Traditional digital banking solves this by having banks keep authoritative records. But cryptocurrency solves it through mathematical consensus across a distributed network. It's truly digital money that doesn't require trusting any central authority. So how do you actually use cryptocurrency? Well, first you need a digital wallet. This isn't a physical object, but rather software that manages your cryptographic keys. These keys are essentially extremely long passwords that prove you own specific amounts of cryptocurrency. Your wallet has two types of keys. A public key, which is like your account number that others can use to send you money, and a private key, which is like your password that you use to send money to others. The critical rule in crypto is simple. Whoever controls the private keys controls the cryptocurrency. This is why you'll hear the phrase, not your keys, not your crypto. To actually acquire cryptocurrency, you have several options. The most common way for beginners is to use a cryptocurrency exchange like Coinbase, Binance, or Kraken. These platforms let you deposit traditional money from your bank account and exchange it for various cryptocurrencies. They work similarly to foreign currency exchanges, but for digital money. You can also buy cryptocurrency through peer-to-peer platforms, Bitcoin ATMs, or even receive it as payment for goods and services. Some people earn cryptocurrency by mining, though this requires significant technical knowledge and specialized computer equipment. Once you have cryptocurrency, you can use it in several ways. You can hold it as an investment, hoping its value will increase over time. You can spend it at merchants who accept crypto payments. You can send it to anyone, anywhere in the world, almost instantly and with minimal fees. Or you can trade it for other cryptocurrencies, or back to traditional money. The process of converting between crypto and traditional money is surprisingly straightforward. Most exchanges allow you to sell your cryptocurrency and withdraw the proceeds to your bank account. This typically takes a few business days and involves some fees, but it's becoming increasingly seamless. Now, not all cryptocurrencies are created equal. Each one serves different purposes and uses different technologies. Bitcoin was the first and remains the most valuable by market capitalization. It's designed primarily as a store of value and medium of exchange, like digital gold. Ethereum introduced the concept of smart contracts, which are self-executing programs that run on the blockchain. This enables complex applications like decentralized finance protocols, non-fungible tokens, and entire decentralized applications. Ethereum's native currency, Ether, is used to pay for these computational services. Other notable cryptocurrencies include Cardano, which focuses on academic research and formal verification of smart contracts. Solana emphasizes high transaction speeds and low fees. Litecoin was created as a faster, lighter version of Bitcoin. Ripple targets international bank transfers and cross-border payments. Then there are stablecoins like USDC and Tether, which are designed to maintain a stable value by being backed by traditional currencies or other assets. These provide the benefits of cryptocurrency without the wild price fluctuations. Some cryptocurrencies focus on privacy, like Monero and Zcash, which use advanced cryptography to hide transaction details. Others, like Chainlink, provide essential infrastructure services that connect blockchain networks to real-world data. The utility of each cryptocurrency varies dramatically. Bitcoin's primary use case is as a decentralized store of value that can't be controlled by any government or central bank. Ethereum enables an entire ecosystem of financial applications that operate without traditional intermediaries. Stablecoins provide a bridge between the traditional financial system and the crypto world. Some cryptocurrencies power specific applications or services. For example, Filecoin incentivizes people to share computer storage space, while Helium rewards people for providing wireless network coverage. Basic Attention Token is used in a web browser that pays users for viewing advertisements. Understanding these different use cases is crucial because it affects how valuable each cryptocurrency might become. A cryptocurrency with a clear, useful purpose and growing adoption has better long-term prospects than one that exists purely for speculation. The technology behind all of this is constantly evolving. Layer 2 solutions like the Lightning Network for Bitcoin and various scaling solutions for Ethereum aim to increase transaction speed and reduce costs. Cross-chain bridges allow different cryptocurrencies to interact with each other. Decentralized autonomous organizations enable community governance of cryptocurrency projects. But here's where things get interesting and, frankly, dangerous. The cryptocurrency world is also full of speculation, hype, and outright scams that have created some of the most dramatic wealth stories in modern history. Let's talk about the dark side of crypto that everyone needs to understand. First, there's the incredible volatility. Bitcoin's price has swung from under $1 to over $65,000 and back down to around $15,000, all within the span of just over a decade. These aren't small fluctuations we're talking about. People have seen their investments increase by 10,000%, only to lose 80% of their value in a matter of months. This volatility creates a perfect storm for psychological manipulation and financial ruin. The fear of missing out, or FOMO, has driven countless people to invest money they couldn't afford to lose. Social media is filled with stories of ordinary people who became millionaires by investing early in cryptocurrencies, but for every success story, there are thousands of people who lost everything. The GameStop trading frenzy was nothing compared to the cryptomania we've seen. People have taken out second mortgages, borrowed money, and even used credit cards to buy cryptocurrency, convinced they were going to get rich quick. The harsh reality is that cryptocurrency investing is extremely risky, and many people who jumped in during price peaks have suffered devastating losses. Then there are the outright scams, and they're everywhere. Ponzi schemes disguised as cryptocurrency projects have stolen billions of dollars. These typically promise impossible returns and rely on new investor money to pay earlier investors, inevitably collapsing when new money stops flowing in. ICO scams were particularly devastating. Initial coin offerings were supposed to be a way for legitimate cryptocurrency projects to raise money, but the lack of regulation attracted countless fraudsters. They'd create professional-looking websites, publish impressive white papers, and promise revolutionary technology that didn't exist. After raising millions of dollars, the scammers would disappear, leaving investors with worthless tokens. Fake cryptocurrencies are another common scam. Criminals create coins with names similar to legitimate projects, hoping people will accidentally buy the wrong one. They also create entirely fabricated projects with fake teams, fake partnerships, and fake technology claims. The FTX collapse was one of the most shocking events in cryptocurrency history. Sam Bankman-Fried, once considered one of the most trustworthy figures in crypto, was running what prosecutors called one of the largest financial frauds in history. Customers who trusted FTX with their money discovered that billions of dollars had been illegally used for other purposes. People who thought their cryptocurrency was safely stored on the exchange lost everything overnight. Terra Luna was another catastrophic failure that wiped out over $60 billion in value. The algorithmic stablecoin system collapsed in a matter of days, taking with it the life savings of countless investors who believed the complex mathematical models would keep their investments safe. Celebrity endorsements have been particularly problematic. Famous people with no understanding of cryptocurrency have promoted various projects to their millions of followers, often without disclosing that they were being paid to do so. Many of these promoted projects turned out to be worthless or outright scams. Social media pump and dump schemes are rampant. Groups of people coordinate to artificially inflate the price of small cryptocurrencies, then sell all their holdings once the price peaks, leaving other investors with massive losses. These schemes often target people who are new to cryptocurrency and don't understand the risks. The environmental concerns around cryptocurrency are also significant. Bitcoin mining consumes enormous amounts of electricity, more than entire countries in some cases. This has led to criticism that cryptocurrency is environmentally irresponsible, especially when that electricity comes from fossil fuel sources. Regulatory uncertainty adds another layer of risk. Governments around the world are still figuring out how to regulate cryptocurrency, and new laws could dramatically affect prices and usability. China has banned cryptocurrency trading entirely, while other countries are implementing various restrictions and requirements. The technical complexity of cryptocurrency also creates risks. People have permanently lost access to millions of dollars worth of cryptocurrency by forgetting passwords, losing private keys, or sending funds to wrong addresses. Unlike traditional banking, there's no customer service number to call if you make a mistake. Market manipulation by large holders, known as whales, is another serious concern. When someone owns a significant portion of a particular cryptocurrency, they can dramatically affect its price by buying or selling large amounts. This creates an unfair playing field where retail investors are at a significant disadvantage. The psychology of cryptocurrency investing often overrides rational decision-making. The combination of potentially massive gains, complex technology that's hard to understand, and social media hype creates a perfect environment for people to make emotionally driven financial decisions. Many people have invested money they couldn't afford to lose because they were convinced cryptocurrency was a guaranteed path to wealth. Stories of people who became millionaires from small investments are constantly shared on social media. But the much more common stories of people who lost everything rarely get the same attention. The cryptocurrency community sometimes develops a cult-like mentality, where any criticism of specific projects is dismissed as ignorance or jealousy. This creates echo chambers where risks are downplayed and unrealistic expectations are reinforced. Despite all these risks and problems, it's important to understand that cryptocurrency technology itself isn't inherently evil or fraudulent. The underlying blockchain technology has legitimate uses and could potentially solve real problems in our financial system. The issue is that the rapid growth and lack of regulation in the cryptocurrency space has attracted both legitimate innovators and criminal opportunists. The challenge for newcomers is learning to distinguish between projects with genuine utility and value, and those that are simply trying to separate people from their money. If you're considering getting involved with cryptocurrency, education is absolutely critical. Never invest money you can't afford to lose completely. Understand that this is an extremely high-risk, speculative investment, not a guaranteed way to make money. Be extremely skeptical of anyone promising quick profits or guaranteed returns. Research any cryptocurrency project thoroughly before investing. Look for clear use cases, experienced development teams, transparent communication, and active development. Be wary of projects that rely heavily on hype and marketing rather than technical merit. Use reputable exchanges and never leave large amounts of cryptocurrency on exchange platforms if you can avoid it. Remember that cryptocurrency transactions are generally irreversible, so double-check everything before sending funds anywhere. The future of cryptocurrency remains uncertain. Some experts believe we're still in the early stages of a technological revolution that will transform how we think about money and value transfer. Others believe the entire cryptocurrency market is a massive speculative bubble that will eventually collapse. What's clear is that cryptocurrency isn't going away anytime soon. Major financial institutions are beginning to offer cryptocurrency services. Some countries are developing their own digital currencies. The technology continues to evolve and mature, addressing some of the early limitations around speed, energy consumption, and usability. However, the fundamental challenges remain. Cryptocurrency is still extremely volatile, difficult for average people to understand and use safely, and plagued by scams and market manipulation. The regulatory environment is still evolving, which creates ongoing uncertainty about how these digital assets will be treated legally and tax-wise. The most important thing to remember is that cryptocurrency is still experimental technology. Despite all the hype and promises, we don't yet know which, if any, of these projects will succeed in the long term. Investing in cryptocurrency should be approached with the same caution you'd use for any other high-risk investment. For those interested in learning more, start small and focus on education rather than trying to get rich quick. Understand the technology, learn about the risks, and never invest more than you can afford to lose completely. The cryptocurrency world can be exciting and potentially rewarding, but it can also be financially devastating for those who don't approach it with proper caution and education. Remember, in cryptocurrency, just like in any investment, if something sounds too good to be true, it probably is. The people who have succeeded in this space long term are those who took the time to truly understand what they were investing in, rather than simply following the hype or trying to chase quick profits. The world of cryptocurrency is complex, risky, and rapidly evolving. But with proper education, realistic expectations, and careful risk management, it's possible to participate in this technological experiment while protecting yourself from the many pitfalls that have trapped so many others. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.